Hey everyone, and welcome back to Everything About Accounting. We've covered revenue and the cost of goods sold. Now, let's put them together to understand gross profit. In simple terms, gross profit is the revenue a company earns from selling its goods or services minus the direct costs associated with producing those goods or services, the cost of goods sold. It represents the profit a company makes before considering its other operating expenses. Think back to our lemonade stand. If you sold $100 worth of lemonade, revenue, and the lemons, sugar, and cups cost you $30, cost of goods sold, your gross profit would be $70. Gross profit is a key metric on the income statement. It helps assess how efficiently a company is managing its production costs in relation to its revenue. A higher gross profit margin, gross profit divided by revenue, expressed as a percentage, generally indicates that a company is efficient in producing its goods or services. However, gross profit doesn't take into account other important expenses like salaries, rent, marketing, and administrative costs. These are considered operating expenses and are deducted later to arrive at other profit figures like operating income and net income. So, to summarize, gross profit is calculated by subtracting the cost of goods sold from revenue. It represents the initial profitability of a company's core operations before other expenses. There you have it, gross profit explained in under 90 seconds. Are you starting to see how each line on the income statement builds upon the previous one? Let me know in the comments. And don't forget to subscribe for more quick and easy accounting lessons. What should we explore next? Thanks for watching, and I'll see you in the next video.